Hello, welcome to AstroFX Fundamental Analysis series of videos. So first of all, we're going to discuss why use fundamental analysis in the first place. Fundamental analysis actually helps you understand the price moves. So rather than technical analysis just focuses on levels breaking or trend lines breaking, etc., fundamental analysis actually helps you work out the underlying reason of why the price is actually moving for any particular reason. Technicals focus on price itself when it moves. Now this is an important point because all of the data that's within the market at the moment is within the price. So let's say we're talking about euro dollar. So euro dollar, for example, could be any kind of data that's coming out on the day or any information that anybody has at that particular time. So the price is the most important thing when we're focusing on euro dollar and just on technicals. Fundamentals preempt moves based on forward thinking. So potentially we could be looking at how a data point is going to come out. What is the central bank's thinking on interest rates? So fundamentals try and preempt this, and you get clues from all different areas of fundamental analysis that helps you work out what could happen on a particular currency based on those clues. Fundamentals can complement your technicals. Now I do believe that this is the best way to use technical analysis and fundamental analysis, and it's together. So let's say, for example, you're at all-time highs in a particular currency. How do we know that this trend is going to continue, or what actually needs to happen for this trend to continue? And this could work with support and resistance levels. Let's say we're at a very important resistance level and we're looking for the price to break through. We might need a certain event to take place for that price to break through. That's why the pair of them can complement each other. Economics actually moves the markets. So let's look at flow, for example. So let's say there's two countries. One country has a higher interest rate than the other one. The money will obviously flock to the country with the highest interest rate. The same thing can happen on the negative side. So let's say that there's two countries and they're both, one of them has a big political conflict and the other one is running very stable and very smooth. You're going to keep your money in the country that's stable and smooth rather than the place that has lots of issues. And it is as simple as that. This is part of economics. Understanding ambiguity. Now this is key. So nobody expected the Brexit vote to happen. Nobody knew that the referendum would get passed and Brexit would get voted in. And this is the point of fundamental analysis, is the fact that at particular moments in time there are things that are unexpected that people don't think are going to happen, and that's why fundamental analysis can be used. Whereas on a chart you're just going to see the price move up and down and you're not really going to be sure why, or why is it moving like that. You might be in a trade and all of a sudden you get dumped out and you're not sure why. This is it. Understanding ambiguity in trading comes from fundamental analysis. Use both together. Technicals and fundamentals do not have to be conflicting. Now I know lots of traders in the world. Some of them are technicals only, some of them are fundamentals only, but the best ones I know use them both together. Sometimes they are conflicting, but this is particularly when you can avoid bad trades. So what I mean by this is the best trades are normally when the technicals and the fundamentals are moving in the same direction, but you can also avoid bad trades. So let's say, for example, we're trading euro dollar and you think euro dollars are long, but every fundamental aspect is telling you that it shouldn't be going up. Then you could actually save yourself from losing some money in that particular trade. Important price levels need a reason to break. So, good example for this is cable. So that GBP USD on the downside, 120 is a floor level, and if it is going to break below that, there needs to be a good reason. Maybe we do not get a good deal on Brexit, maybe we crash out without a deal, something like that, and that can take us below 120. But that's an important price level, but something needs to happen for it to break, not just because it's there technically. So sometimes something breaks, but with a weak reason. So let's say an example of this, we get a price that's pushing up and pushing up and pushing up, all of a sudden meets a very strong resistance, but when it does break, the reason isn't good enough. So we all sit here and know, doing our fundamental analysis, that yeah, the price did break that important level, but it really shouldn't have done that, and then it comes crashing back in. So this helps you identify false breaks, and also false breaks of support, false breaks of resistance, and trend lines. Fundamentals are more popular with investment banks and hedge funds. This is a 100% true statement. I've visited many of them in my lifetime, and I'll probably say the split between fundamentals and technicals is about 80% towards fundamental analysis. Now, it's a constantly changing, evolving subject, so you have to keep up with economics and the news all the time. But the thing is that within hedge funds and investment banks as well, now we'll look at technicals for their levels and maybe their price targets and things like that, but their decisions will purely be made on fundamental analysis. The consensus of the market is a very, very, very important thing. I cannot stress this enough. So this is what the market is looking out for. And sometimes when it doesn't achieve what it's looking out for, this is when you could get the best possible outcomes in your trading. And I'll explain this a little bit later on. Making a plan. I don't think any trader should enter the market without a plan. When trading fundamentals, you have to make a trading plan. And how can you manage your risk? So that's a key thing. We're going to do a whole session on making a trading plan, so we'll discuss that further later on. But managing your risk is key. There's no point playing this game if you can't afford to stay in it. What events actually move the markets? You need to know this. There are some events that are flagged up and perceived to be important, but don't actually do anything to the markets. You need to know why. Find out when not to trade and when the markets are quiet. Now, I've found this out the hard way a couple of times in my life. So for example, the summer months are completely dead, the winter months are completely dead, but because the markets are so quiet in terms of the amount of traders that are there, sometimes you can get these wild swings that can put you in and out of trades. So that's something to know. Also, at the moment, we're noting that Monday trade is really, really quiet. So if you're looking for a volatility and you are an intraday trader, there's no point trading Mondays at the moment, but fundamentals can help you with this. Key risk events can make or break your P&L. So obviously, if you're in a trade and some risk event comes out, like ECB interest rate decision or Mario Draghi speaking or Christine Lagarde now, and it can really move the price really quickly. Now, let's say this happens, it can obviously work in your favor, but can obviously work against you as well. But understanding when these events are and what they're about can make and break your P&L. Work out which news is important and which news is not important and what the key themes are. So, example again for this. Let's say for sterling, Brexit is the key theme. Everyone's discussing Brexit or the general election. Now, services PMI might be out on that day, or retail sales might be out on that day. Nobody is going to care about it. The whole point of this is what's happening with Brexit, what's happening with the general election. Don't get me wrong, the price might blip higher or lower during that event, a really short amount, but the whole point of trading is working out what is going to move the markets and what's not going to move the markets, and how to manage your money and your risk in between there. So that's the key points about making a plan. So moving on with the rest of the sessions, we will be focusing on individual data points like GDP, inflation numbers, interest rates, things like that. But they'll come later on in the series. But also right at the end, we'll work together on how to make a plan, and there'll be a video on how to work out how to trade fundamental analysis, because obviously it is a bit different to trading technical analysis, and you need to know what to look out for and what not to look out for. But there's the rest of the part of the video series to help you with that. So what we'll cover in that is how to use the economic calendar. So I've got a picture of an economic calendar here and what's coming out on that session. Already mentioned that we'll cover interest rates and why they're important. Inflation is another key metric. Gross domestic product, which is GDP. Manufacturing data. Confidence and how that works. Politics is another big thing. And lastly, making a trading plan.